This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis with their experts Manus, Clancy, and Dianne Crocker. It's the week ending February 6th, and here are a few of the macro highlights we're tracking. Job growth came in lower than expected. Kevin Warsh is reportedly in line to replace Chair Powell in May. We avoided another federal government shutdown. Gold saw its worst day in 45 years, and stocks are on a roller coaster with big sell-offs in tech. Manus, what stood out to you in this week's market news?
It was really an incredible week, and it shows the risks of putting out a weekly podcast because things can change so very quickly. We record on Thursdays. Last week, the market was quite calm. We saw very low volatility. Markets were setting new all-time highs. Transaction volume in CRE was very steady. People were feeling confident. And then less than a day later, all hell breaks loose. The announcement of the new Fed chair-elect, Warsh, by the White House seemed to set the market off, and for no good reason. He seems like a safe choice. He seems like somebody that is committed to Fed independence. In the past, he's been somewhat hawkish. That's the kind of nominee you would expect would calm the markets. Yet what did we see? An enormous stock market sell-off on Friday, gold hitting its worst levels, its worst one-day sell-off since 1980. Silver similarly having its worst day since 1980. And you think, what is going on here? We get to Monday and Tuesday, the markets settle down a little bit, but back to Wednesday and Thursday of this week, again, it's a big sell-off. Crypto today down to 67,000 per coin. That's down from an all-time high of about 120,000. So we're talking about almost a 50% decline in crypto. We're seeing some of the big tech high flyers dropping 5, 10, 15% in a single day. We are seeing gold bounce all over the place, but right now it's still down about $1,000 per ounce from its peak. So it does feel like something has changed over the last couple of days. The NASDAQ now down to its lowest level in almost 3 months. And you ask yourself, what is that trigger? And I'm not really sure. We've been saying since last summer that the market feels stretched on the equity side, that we feel like it's a little too complacent. People are a little bit too bought in to this AI trade, too bought in to these stretched PE levels. And this week was a turning point, and we've gone from being very complacent to very fearful in a couple of days.
It's true, Manus. It was one of those weeks where every headline kind of seemed to be pointing in a different direction. I've been here trying to finish a market keynote to give on Tuesday at the Environmental Bankers Association in San Diego. And just when I think it's done, something else happens that changes the messaging. Like I just added in the jobs report that came in weaker than expected, as you just said, Alyssa. Layoffs in January were the highest to start a year since 2009, which on its own, both of those raise questions about the weakening labor market, which we've been talking about for a while. Everyone's gaming what's going to happen with rates. I agree with what you just said about Warsh as the guy that Trump is tapping to take over. I think it's clear that Trump will put someone there who does what he wants them to do, which is to lower rates. So that certainty, I think, is good for a market that hates uncertainty. And certainly the path to lower interest rates has been uncertain for a long time. I was also really relieved to hear that we did avoid another federal government shutdown, especially after how long the fall one dragged on. I mean, we're still catching up with the delays in economic data from last fall. And then on the bank front, Manus, I don't know if you saw this, but the big news here in New England is that Santander is acquiring Webster Financial. So there's more consolidation on the regional bank front. I was trying to think of other bank consolidations recently. There was Fifth Third and Comerica. There was Huntington and Cadence, Synovus, and Pinnacle. So some pretty sizable consolidations on the regional bank side.
If I'm not mistaken, the consolidation will put together a portfolio between the two banks of over $30 billion in CRE loans. So a lot of CRE concentration there. I know Webster has always been very active in CRE lending. I didn't realize how much Santander had done. So an interesting news there. For those that don't know, Over the last 3 weeks, Dianne and I have started to put out weekly commentary on the markets. And thank you to all of those who have subscribed. We really appreciate you following this. We love writing this research. But I started mine this week by saying, when I wrote it early this week, it was the worst of times. It was the worst of times. And of course, that's hyperbole. The great financial crisis was really the worst of times. We saw everything selling off, markets collapsing, the tech bubble bursting in 2000. That was another worst of times moment. We're not there now. We're seeing the NASDAQ down 6%. It's not dreadful at the moment. But I use that hyperbole because what we were seeing Friday and then again this week was normally when you see these shocks to the system, when equities are selling off, when crypto is diving, when gold and silver are diving, people race into the safety of treasuries. And the one thing we haven't seen this week is the 10-year treasury dipping extraordinarily lower. Yes, it's lower today. Yes, we're at 422. Yes, it was 428 a couple days ago. But you would think, given the volatility, we'd see that 15 or 20 or 25 basis point dip as people race out of risk assets into treasuries. That would always be the silver lining. We're not seeing that today. And that's kind of like a double whammy for CRE. We're dealing with heightened volatility, and we're not getting the tailwind of a lower rate, at least not yet today.
And is that just a short-term thing or a longer-term trend that's taking root? Because one thing we learned last year is there are these kind of jolts to the market, and there'll be a stock sell-off, and we'll kind of hold our breath for a week or so, and then everything will level out and kind of go back to normal, and we could exhale. So I feel like we're conditioned after almost a year of these wild swings to kind of think, okay, well, what's the worst case scenario here? And then just when we're starting to think, okay, this might be really bad, then the ship rights itself and we move on to something else. So it's been pretty crazy.
I want to separate the sentiment from the data because sometimes these two go in two different ways. Sometimes there's no data to trigger something. People just come to the conclusion that it's time to take some chips off the table. The market is stretched. Gold, silver, remarkable run-ups this year. Equity prices remarkably higher when you consider how much they had melted up since May of 2025. And sometimes these corrections happen just because people think we've come too far too fast. That's how I felt on Friday, that the Warsh nomination was not enough to explain the volatility we saw. This seemed to be more of a sentiment move on Friday where people say, you know what, I'm going to take some chips off the table. I'm going to live to fight another day. Let's pocket the 30% uptick we've seen in equities or AI stocks or in gold, and let's de-risk a little bit. But since then, we've seen some data points which say maybe it's not just the sentiment. Maybe there's something beneath the surface. So today, really anemic ADP jobs number, 22,000 jobs added. That is just puny. We saw the JOLTS number really underwhelmed today. Far fewer job listings out there than people were expecting. We've seen the challenger numbers where layoffs are really starting to pick up. And then we saw some of these earnings where Microsoft saying our data center numbers not as high as we thought they would be, the AI adoption a little slower than we thought. And on some of the big Magna stocks, expenses exploding higher to levels that people didn't see coming. So I think we're seeing two things happen here in real time. People were nervous about valuations and said, at the first sign of any turbulence, we're out of here. And the second part of it being, now we're seeing real data, and it's kind of reinforcing that panic.
Could be. It's been a long run, of course, as you pointed out, that really has pushed those valuations in the fields of software and in AI-linked stocks to these stretched levels. So the longer that carries on, I think the more skittish that those holding those stocks will be. So at the first sign of any kind of danger point, they're going to be quicker to let go of them than I think they were a year or so ago. So it's definitely concerning. I hope it's more about repositioning than any kind of long-term panic, but we'll wait and see.
So let me ask you, Dianne, I usually find your instincts to be very strong. And let me ask you two questions about that with the wait and see still kind of floating out there. What does your gut tell you now that we're kind of 5 days into this? Is this a healthy bloodletting, or do you think this is the start of something bigger? Is the data just kind of the tip of the iceberg, or do you think that by next week we'll be talking about, well, we're glad that's over?
I think by next week we'll be talking about, well, it's over, but that could just be my hopeful side, not trying to jump to worst case scenarios. But I think, and we talked about this a little bit last week, things are starting to feel a little bit more edgy than they have, in a while. And I feel like the market's in a more fragile position than maybe it was even like 3-4 weeks ago when we were just after New Year's.
So the second question is kind of related. So let's suppose that this becomes more than just a 2-week story, that we see the NASDAQ and the S&P 500 shed 15 or 20% like they did last April when the tariffs were announced. Can CRE shrug that off and just soldier through a second time in 12 months where CRE pros just kind of see it as two different markets? Yes, AI is stretched. Yes, equity valuations are stretched, but that has nothing to do with rent growth or inventory levels or consumer spending. It's business as usual for CRE.
I do think it would take a lot for the momentum that's built up in CRE to start to ebb. And that's not just the optimist in me talking. It's from the folks on our market advisory council who took surveys and shared their forecasts for this year. It's talking to lenders who are attending the conference next week to see how they feel about the market. And the general sense I'm hearing pretty universally from the folks in the trenches of the market is that investors and lenders are feeling good about placing capital, certainly more so than they were a year ago. And it's partly because of more pricing clarity. It's partly because rates are becoming a little bit clearer, I think. And because all the deals that we talk about here on the weekly podcast bring us a bit closer to price clarity. So it feels a little bit less risky to buy things like office towers in a way that people weren't even thinking about doing a year ago. So I think it would take a lot for CRE to lose the momentum that we've seen building over the past couple months.
I think I'll take the other side of the coin on both questions. I think I'll take the glass half empty to a degree, not a panicked degree, but I will say this. This feels like a 6% or 7% NASDAQ sell-off is going to turn into a 15% sell-off, that we'll be talking about this for a month or two, that I don't think it's an unhealthy bloodletting. I think the markets had gotten frothy, but I do think that there's something a little bit different about this now than there was, let's say, the last time we had a mini correction in October or November. It feels a little bit more widespread. I'll leave that there for now. On the CRE thing, I think I generally agree with your thesis with one caveat, and the caveat is this market has become so dependent on non-bank lenders, on the PE lender side. And there's so much turbulence right now about PEs becoming lax in the private loan market. Now, those are two different markets. PE CRE lending and PE corporate loan lending are two different things. But if they start getting commingled in people's minds, PEs themselves are funded by banks. And if people start saying, we are going to reel in some of your leverage here, we're going to reel in some of your latitude, we're not going to be as free and easy with your warehouse line, I think that's the one thing that people have to watch. If banks start pulling in the reins on PE lenders, I think you start to see liquidity disappear a little bit, and that could be a net negative. We'll see. Something in the back of my mind.
That's what makes forecasting so incredibly difficult, is that you use the term glass half full, glass half empty a lot, and you could make an easy case for both of those right now, just based on a lot of the things that we've already talked about today. But the good news is we get to talk about this every week. So we'll get to watch those two things and see where things land.
If there are two data points for the tourist, the market watcher tourist to watch over the next couple of weeks, it would be this for me. One would be BBB minus CMBS spreads. They've been largely range bound for more than a year, usually around 450 basis points above the 10-year Treasury yield. If we see that cost of funding go up, if people demand higher risk premiums by a substantial amount, if they go to 550, 650, 750, you'll know that liquidity is getting tighter and tighter. And I would say the same thing about CRE CLO spreads. If you start to see CRE CLO spreads moving materially wider, I would say the same thing. So if there's two data points for those of you out there that are CRE pros but don't really follow the markets day to day, those would be the two I'd keep an eye on.
So, Manus, that's a nice pivot to the data dive this week, because I want to talk about the January CRE activity index. I have a few components to share, and I have to say, after the conversations we've been having, where the news has been kind of a mixed bag on the broader markets and there's been some kind of building anxiety, I have to say I was kind of bracing myself as I opened the data to see what it showed for January, thinking maybe it will be weaker than what we've seen in a typical January. Maybe we'll see the early signs of that momentum starting to kind of ebb a little bit. I will say I'm happy to report that on the environmental due diligence and property listings front, the January data was pretty positive. Environmental due diligence, these are the phase one environmental site assessments that are conducted before loans and commercial real estate deals. That volume in January was up 7% over December. It was up 27% above last year. And it typically dips in December, and then we see a slow increase in January before higher momentum kicks in February and March. So on that front, it was a sign the year was off to a strong start. And then on the commercial properties listing front, kind of the same theme. The December volume of new properties coming on the market was characteristically slower heading into the holiday season. But in January, it was all systems go. We saw listings that more than doubled where they were in December, and they were 25% above where we were last year. So although we're starting to feel like there's some cracks in the foundation maybe taking root, these are two prongs of the index that came out strong, so far this year. And of course, your transactions data, Manus, for December showed that was the most active market on a monthly basis that we saw for deal closings in all of last year.
Those are all great data points and give us a lot of reason for hope that the CRE market will not be pulled down by broader factors like crypto, like gold, like the equity markets and so forth. But I will be very, very eager to see that February number. Because the volatility started so early in February, it'll be interesting to see if it does have any ramifications later in the month where people are a little bit slower to pull the trigger on new listings or new work, new lending, new appraisals, et cetera. But I also think, this is kind of a parenthetical as well, it has been such a brutally cold month that you wonder if the wheels of progress between late January and February will be slowed down by the fact that it never seems to get above 10 degrees anywhere but California and Arizona these days.
True. And maybe when I open the February data, I'll have that same kind of sense of unease that I just had when I opened the January numbers.
Dianne, let's shift gears and head into our Did You Know for the week.
I just ran the hottest markets for environmental due diligence in 2025 for our quarterly snapshot report. And the top 5 hotspots were Houston, Nashville, New York City, Long Island, and Chicago, where growth in due diligence volume far exceeded the U.S. industry benchmark of 13%. So what does that mean? It means if you're focused in any of those top 5 cities, you're in the right place, because elevated due diligence demand usually points to metros that are in investors' crosshairs. So those will likely be hotspots this year as well.
Great data as always, Dianne. Thank you.
Let's jump to the CRE stories making headlines this week, starting with sales coming to market.
So we spent a lot of time talking about market sentiment and activity, Dianne, talking about several factors that weigh in on our activity, index listings being one of them. We had several properties that were highlights of news articles that are talking about big properties coming to market in major metros in the near future. We don't talk about this much. What's coming online, what's coming over the horizon. But given the turbulence that we've been seeing in the market lately, I think these will be very, very interesting ones to watch over the next month or two as they come out. And I'll run through them in short order, then I'll give you a chance, Dianne, to react to any and all of them if you want. The first one, Empire State Realty is hoping to nail $350 million for a Billionaires Row office building. Billionaires Row, for those that don't know, is 57th Street in Manhattan. It's where Extel and others have put up those 100-story condos, apartments that go for anywhere between 10 and, I guess, $150 million each. They overlook Central Park. Here we have Empire State hoping to sell this 540,000 square foot office building at 250 West 57th Street. It's a 26-story building, mostly office. There's street-level retail occupied by TJ Maxx. They will be in that lease until 2041. A Chicago one. This will be very, very interesting for us. Chicago, really one of the worst places in terms of decline in office valuations. But Irvine Co. is going to try to capitalize on the shortage of supply for A-plus rated offices and the momentum that highly amenitized offices have been getting nationwide. They are going to put One North Wacker Drive on the market. Danny Ecker of Cranes with reporting there. That property, 92% leased. Tenants include IBM and Mayer Brown. In South Florida, RFR is looking to move 100 Biscayne Tower. They're hoping to get $130 million for this 310,000 square foot property. And in South Florida, this is the other side of the coin. A headline here from Lydia Dinkova of The Real Deal. In South Florida, 2 properties are coming to market at a time when rent growth has been, in her words, lethargic. Here, Stratford Management is looking to offload Riverland Apartments in Fort Lauderdale, hoping to get $90 million. They had paid $84 million for that property. And CIX Capital, also in South Florida, looking to sell a 240-unit village at Mangonia Lake. So a lot of sales, kind of underscoring what you're seeing, Dianne, a lot of things being listed for sale. These ones are big numbers. I think that they will be market moving when they come in, and they will tell us, is the market holding its own, or is it starting to show a little bit of nervousness?
Yeah, I like this, Manus, for the reasons you said, that we often talk about deals after they've already closed. And these are a little bit different. You know, the Empire State listing is different than some of the other office stories that we've been talking about, where these distressed offices with high vacancies are going on the market and selling for some distressed value. And this is an office with a really strong retail component. Empire State made a significant investment in it to the tune of $140 million. And they're looking to get that back. And they probably will, based on similar deals that we've seen in Manhattan in that same area. And the one that struck me about the Chicago listing is, we just talked, I think, last week about how vacancies in downtown Chicago office hit record highs. You know, but these assets are kind of operating in a different universe than some of the distressed deals that we've been talking about. And, you know, it might trade far above the distressed pricing that we've seen in recent Chicago office deals. And I think with both of those listings, I'm sure there are a lot of eyes waiting to see what they go for, because we're in the midst of this great office reset.
I'm going to take a little bit of a detour. I didn't expect to go here, but you triggered a thought in my little brain here about a conversation I had a little while ago. And I was talking to somebody about bank loans on offices. And the topic came up, you know, for those that don't really follow the banking market per se, you make a loan, you assign it a risk rating. If the risk rating is 1, 2, or 3, it's considered a very healthy loan. If it's, you know, 4, 5, or 6, maybe you're thinking that the loan's a little riskier. Maybe you should get a higher interest rate for it. Maybe there's a little bit higher chance of a loss on the loan, but you're probably still feeling good about it. 7 or 8 or 9, it's kind of an impaired asset. You're going to take a loss on that. And then you have like loss provisioning, where somebody has to say, okay, I have this loan. What kind of loss should I assign to this? And what kind of capital needs to be set aside for this particular asset. And the conversation turned to office where people were saying, when the examiner comes in and the examiner says, let's look at your office book, how hard it is to explain the fact that, yes, in Chicago, most offices are down 60%, but this one here is up 15% or 20%, that this is grade AAA. And I can only imagine how hard it is to have that conversation when the bank examiner comes in, when you're trying to subdivide markets by neighborhood, by class, by value, and you're trying to make a case for something where every headline is negative and you're trying to hold the line on something where you're saying, no, this is money good. This loan is good. This is a highly desirable location. It's highly amenitized. This thing is going to pay off. And I don't know if you have thoughts on this, Dianne, but it struck me as, at least academically, a very interesting conversation from today.
Yeah, I agree. And it's a difficult case to make. And so every round of transactions that brings the office reset closer is going to make that argument easier and easier to make. But we're in this for the long haul, as we've talked about before. This process will take years, and it will impact not just office pricing, but also local government budgets. It's just going to take a while for assets to kind of work their way through. The listings that we're seeing, the deals that we're seeing on the office front is making, I think, the market kind of collectively feel that putting office assets up for sale is a safer bet, certainly today, than it was a few years ago. And, feeling like, hey, let's put it up there and see what we get. We might get decent price on this and not take a haircut.
So you've given me a great segue to go into our office segment. I have two office stories here that talk about the past and the future here, both kind of happy stories, if you ask me. The first one comes from Francisco Alvarado of The Real Deal. He talks about, in Coconut Grove, Florida, how Taros and Sabal have flipped an office property in Florida for a $28 million gain. They brought a property in South Florida for $28 million a couple of years ago, pumped a little bit of money into it, and now have flipped it in Coconut Grove for $61 million. So this property at 3480 Main Highway is an example of somebody who has stepped in, taken some risk, and is being rewarded handsomely for it. A second story that we'll see how this one plays out. This comes from Cranes. David Werner has acquired for $41 million the old post office building from Brookfield Asset. Talk about a property that has really bottomed out. Brookfield acquired this asset, 22 stories, for $306 million in 2018. David Werner now acquiring it for $29 a square foot for $41 million, 87% discount. And let's hope that he has the same outcome that our previous buyers had in South Florida, right? You want to reward this maverick behavior where people come in and say, you're turning right, I'm turning left. I'm going in, I'm investing in downtown Chicago. I think the market has bottomed. I'm willing to put my money where my mouth is. I hope that David Werner makes a nice return on this, and anybody else who dips their toe in the market during these turbulent times.
Yeah, agreed. Those are great stories. And to your point, it's the Mavericks that kind of help take away the fear factor that everybody else might be feeling. And it's risky. They went out in front and it paid off for them. So that's amazing. I have to think that makes others feel better about doing the same. But I kind of wonder, when they first proposed this, if people were like, you're crazy, who would buy an office and hope to flip it for a profit in this market? And he showed them, and that's amazing. It's great.
The further we get away from this story, the fewer people remember it. We're now almost 20 years past the great financial crisis, but the best of the feel-good stories for me in that 2009, 2010, 2011 still was Appaloosa Capital coming in, and just as Werner and others are buying offices at $29 a square foot, Appaloosa came in and bought mezzanine and junior AAA CMBS bonds at 10 and 15 and 20 cents on the dollar. So 20 cents versus par. And in many cases were paid back at par. right? So they made 4, 5, 6x their money. They went against the grain in those years after the panic or the great financial crisis and were rewarded extraordinarily handsomely. It was an all-time great trade. And let's hope it works out this way for the office buyers too. I love a great story like this.
I do too. Better than talking about distressed deals. And we've talked about many of those in the past few months.
While we're talking about happy stories, let's talk about somebody else putting money where their mouth is and taking a chance on new development. Dianne?
Thanks, Alessa. There's an interesting one. This one takes us to beautiful Santa Monica, California. Trammell Crow is proposing an 8-story building at 2716 Ocean Park Boulevard. And the proposal is for 456 residential units, 6,200 square feet of ground floor retail. So it's a combo of residential and retail. And the interesting thing about it is that they're taking advantage of bonus incentives by the local government and designating 46 of the 456 units for below market rates. So it allows for a taller structure, but they're also bringing some affordable housing into the mix. And I think it's interesting because we've been talking about a lot of office to resi development in New York City, but Santa Monica is a new one. You know, multifamily development, I think in a lot of cities is really gaining traction with the boost of local incentives that include carve-outs for affordable housing units too.
This is what we've been talking about a lot, really, in the fourth quarter, how there was a lot of confidence that people were willing to put shovels in the ground. Lenders were willing to lend on speculative projects, and we all felt good. And I'm hoping that when we get to the end of Q1, we're still feeling that way, that this uncertainty that we're feeling this week doesn't result in people feeling that they need to pull back. I'm hoping that new development, new lending on risk assets remains in place because it's been a nice 6-month stretch that we've seen a lot of new projects announced. And I like you bringing this up, Dianne. I think it's a healthy sign that people are still putting capital to work. Let's hope it's still true 3 months from now.
Let's wrap with our slice of life. Super Bowl Sunday is this weekend. The Seattle Seahawks and New England Patriots are set to face off. So Manus, Dianne, who are you picking to win?
You know what's funny? I remember years ago, Manus, and you might know this too. Years ago, Roger Staubach was at JLL, and he used to make his Super Bowl picks based on which host city had the stronger real estate market. And as I remember, he had a really good track record of like picking the Super Bowl winner correctly 60 to 70% of the time. So I started thinking about Seattle versus Boston, you know, and the markets. And it seems like it's a tough call if you're going to pick the Super Bowl winner based on markets because Seattle's market's very strong. They have technology, industrial, logistics. Boston's strong for other reasons. They're strong on education and healthcare and finance and universities and research. So I don't know, maybe that means it'll be a close game, which is always more fun. I think my friends in New England will get mad at me when I say I don't really care who wins, because I'm not a Patriots fan or a Seattle fan, but I did bet $20 in the LightBox football pool. So if I recoup that by winning a square, I'm happy. And I think the halftime show is always the best part.
The halftime, the ads, the comfort food that gets served at the party, all of those are great things. But if I had to go with an alternative measure to pick the winner this year, and by the way, I think Seattle is the better team. I think Seattle will win going away, but if I had to pick a team by some alternative measure, I'd wake up Sunday morning and I'd say, where is the temperature highest? That's the team that's going to win. The team that it's going to crack 40 degrees today because I have been so cold for so long. I want to hear about temperatures breaking 32 degrees Fahrenheit.
I like where your head's at, Manus. 32 degrees sounds pretty nice right about now. And with that, we'll close. Thank you to our production team at Bruning Media. Join us every week as the LightBox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.